Hi, my name is Dana Golden. Today I'm going to be talking about my work, investment and transfer of power, dynamic effects of transmission in electricity markets. My work focuses on the impacts of transmission expansion. Renewables are very dispersed around the country, so there's a lot of solutions for that, and the main one being transmission, send more electricity from one place to another, but long distance transmission has been minimal to date. So my research questions are, if we decrease transmission constraints, if we build out transmission, what is the impact on prices across regions? If you decrease market frictions, what is this due to capacity investment? And if you have transmission expansion, how does it affect emissions and reliability? My contribution is a model of how transmission constraints shape prices and quantities in a multi-grid node. This is a unique data set I constructed myself with a comprehensive short-run marginal cost estimated for all resources in an econometric model, a dynamic perspective that integrates transmission with a long-run model of electricity markets. I have a data feature here. I show how prices of renewables vary with space and time. So prices are very much related to the renewables, where heavy renewable regions in the Midwest are low price, and then low renewable, high population regions out on the East Coast are higher price. And then we see the same variation across time at an hourly cadence with a little bit of a shift over in terms of the peaks in the price in Long Island, the peaks in the price of the Midwest by about an hour due to time zones. So in electricity markets, we have what's called locational marginal price, or LMP. This is the cost of energy, the marginal cost of energy, which is the generator at the margin, plus the cost of losses, plus the cost of congestion. This is formed through this network, where the marginal generator after congestion sets the price. If the prices are all equal, the price at each demand node is equal. But there's these A's here that limit the amount of electricity can be set. So now the marginal generator is different, leading to a different LMP. In my model, I use that network in my short-run model, which is a dispatch and locational marginal price solving problem. And then this feeds into prices, costs, and expected profit, which feeds into capacity investment, which feeds back into the short-run model. Graphically, trade equalizes price, prices equalize across regions. This creates higher prices in renewables-rich regions, which incentivizes entry and investments in renewables. The ISO in my model minimizes the cost of generation subject to Kirchhoff's laws, line limits, and capacity constraints. And then in the long run, generators expand capacity and reduce capacity to maximize profits. In terms of preliminary results, we find that full HVDC upgrade decreases average price by 6% with welfare gains of $4 billion per year, with long run impacts pretty significant.